Man, another one of those boring July summer days with no news necessarily. There was some news, I guess, but nothing really until the market closed. So it was one of those boring, grinding summer days. But there was one asset class that had a breakout move, and we're going to talk about what it means for the market posture and how to trade it. So let's go ahead and get started. Today is Monday, July the 23rd, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thanks for tuning in tonight. Subscribe to our YouTube channel by mousing over the Market Scholars logo on the bottom right corner of your screen. Click the subscribe button that pops out in red there. Click the thumbs up icon down below the video. That tells me you like the video, you want me to keep doing it. Comment on down below further on anything that stands out to you from tonight's video. There's a link popping in the top right corner of your screen. Click on that link and subscribe to our daily Market Outlook email. Follow me on Twitter for more content like this throughout the day, and join our Market Outlook community on Facebook. All right, let's go ahead and take a look at the S&P 500 first with the market forecast indicator down here at the bottom. You can see the green line. The intermediate line is still up above the 80th percentile, which suggests we maintain a strong bullish posture in the intermediate term. Of course, it just barely crossed above that, and that's what turns the chart darker green here. And when we get those darker green areas, that's the expectations is 1 to 3 months. Again, I'm going to venture to guess on this go around probably closer to 1 to 2 months because of the seasonality and the time of year, and just the fact that we expect 2018 to be more volatile than what we saw in 2017. That expectation is solidified with that overbought cluster there, where we got all the time frames where the bulls were in control across all those time frames there. The near-term line did pull back, and we talked about that bullish intermediate confirmation signal on Friday. This kind of buy the dip signal. We bounced right off of that today. I kind of expected that we might wait until after Google announces tonight to bounce off of that. And really get things going Tuesday, maybe even fill in. We started off down too, but we started to bounce already before even the announcements or the earnings were announced this evening. It wasn't enough. It was enough to bring the momentum line out, not enough to bring the near-term line back up above 50. Once it gets above 50, the blue line, then you expect a 7 to 12 day near-term run, similar to what we saw right here. So we'll see if that ends up being the case. It really wasn't much of a near-term pullback. I mean, 2 days is all it took. That's how small of a pullback it was to get the near-term line below 50. So probably because of that, it's like the inhale, exhale. The market has to breathe in and breathe out, and every time there's a shallow exhale and then followed by another inhale, then we get what we saw over here, where we just take a big deep breath because we never exhaled really significantly on the way in. So that's kind of what, maybe we might get about 7 days here if we start to run. I remember from the seasonality standpoint, now we've hit July expiration. Last year we saw, for over the last 20 years, this is where we start to decline into the middle of August. Last year we didn't. We were flat for this next couple of weeks until some weakness in August. If I were to zoom out here, you can see over here we were flat for a while after July expiration. Then we had some weakness in the middle to end of August, around August expiration, that we then subsequently bounced out of. So we'll see if we end up going flat. Of course, big week this week with GDP at the end of the week and earnings from big tech names out, Google already, and you can see if you look here in the after hours, Google's had a positive impact. SPY is up 40 cents in the after hours after a 50-cent move today. So pretty decent start. But again, just like we saw, today, pre-market moves are not nearly as solid as what happens when the market opens up. We started, we were bearish all night last night and into this morning before we started to bounce as soon as the market started to get some volume today. Let's take a look at the Dow Jones Industrial Average here, and you can see we are pink now. The posture is, the intermediate line has turned down. It's only a light pink, so it's a weak bearish posture. Technically, we're still on this intermediate run, and with the S&P bouncing, you would expect the Dow to follow suit. You can see the near term line has avoided the reversal zone, and it's still obviously forming a much higher low point here. And then if you take a look at the NASDAQ composite, looks very similar to the S&P 500 with some strong market sentiment almost above 80, the orange line. And then finally the Russell 2000 also showing a strong bullish posture with the intermediate line now getting back up above, and the near-term line pulling back, but not. Remember that we talked on Friday, the Russell 2000 is just starting a near-term run. It's kind of looks like it might, because it pulled back quicker. It didn't keep going up as much as these other indexes did. It's kind of, now it's starting a near-term run, and that would lead these other larger cap indexes in their new near-term runs as well that we expect to start through most of this week and into next week. All right, before we look at some other charts here, I want to remind you that you can watch the Market Outlook through our Market Scholars blog. It's marketscholars.com, and then click on blog up here. You can find the Market Outlook post usually towards the top of the blog. You can see our calendar for all of our classes that we have coming up later. And again, we asked for 3 clicks here, and that's our feedback. That lets us know you want us to keep doing the videos. You can do it right now while you're watching. 1 is to like today's Market Outlook tweet. 2 is to click here. That will take you to your Facebook account where you can like tonight's Market Outlook post on my Facebook page. And then finally, you can click here on the blog and like. Those 3 things tell us you want us to keep doing this and putting these videos out on YouTube. Number 1. Number 2, it tells Twitter and Facebook that you think this is good content that they should be sharing out to all of our followers that we have. As you know, they don't send out all of our content to everybody based on their algorithms. So it's a way for you to recommend this to other people in 1 click. All right, now let's take a look at a long-term view of the S&P 500 to see our new weekly candle that's developing. And again, above a rising 50-day moving average. 50-day moving average is above a rising 200-day moving average. The gap between the two is getting bigger, so bullish all across the board from a long-term perspective. And we're not too extended away either from the 50-day moving average. We are a little bit, but not too far. And especially not above, if I were to change that MACD down there at the bottom, let's see, excuse me, over here, and then we're going to come to the MACD and let's change the fast to the current price. You can see, we've been, usually it looks like about right here, about 150 points is kind of our upper bound. We're up there. We're not quite there, but we're up above the 200-day moving average. To about an extent where we usually start to slow down at least. Finally, we'll look at the 3 green arrows for another intermediate look, and we can see we have all 3 green arrows. We're above a rising moving average. MACD is positive. The momentum is positive. The buyers are in control according to the stochastics indicator. You can see we're still above an 8-day moving average. So that near-term pullback in the market forecast got us to the 8-day moving average. I kind of thought maybe we might pull back a little bit further and get down to the 17-day, but we instead ended up, or get closer to the 17-day, but instead we ended up holding the 8-day and continue to rally, even if the MACD is pulling towards its moving average and the stochastics is already crossed below its moving average. Keep in mind that the stochastics is, the moving average for the stochastics, the orange line, is relatively high and can stay high for a while, as we kind of move and grind our way slowly above. And even like we did last year, as we kind of grind our way slowly above the 8-day and even start testing the 17-day moving average as that gap between the two shrinks, which is illustrated by the blue line dropping closer to 0, grinding its way to 0. All right, if you take a look at the intraday chart, we're easily in the upper half of the chart, which would shade the short-term chart green, right? So from a long-term, the intermediate term, the market forecast and 3 green arrows are both shaded green. Long-term chart shaded green, and this chart shaded green in terms of being up in the upper half of the chart. You can see this near-term pullback didn't even sniff the 38% Fibonacci retracement. And remember, these lines aren't going to move with the midpoint here until this gets off the chart over here to the right, and it'll start to move up slightly and slowly now. So we'll probably start to break through to new highs this week. We'll start to break through that as this starts to move its way off to the left over here. Let's take a look at the volume today. First of all, let's go back to the first. I always forget to look at this before we get going too far to remind ourselves. You can see today's range easily below the average range, so very, very quiet day from that perspective. And then, of course, looking at, let's see, actually we should look at this one, shouldn't we? There's our range. You can see the volume at 47 million down here at the bottom, also well below average. I mean, this was a summer day. You look at the how those averages compare. 42 million, or what, 40 some odd million, wherever it was, is well below the low end of the 52-week range. The range today, 1.37 points, 1.3 points, also below the average, bringing it down. You can see the average ATR is also below 1%, so that's bullish. This chart would be shaded green according to that. And then finally, if you look at the volatility chart, you can see volatility has been slowly staying up pretty high in the high 12s and 13. Just not a whole lot of room it can go down. So that's when volatility can't really go down a lot, then the markets grind their way higher. They go slowly and just kind of slowly move their way. And you can see right now we would be forming a higher low point with what the MACD and stochastics are showing us on this hourly chart. But we're not expecting a big jump in volatility anytime soon because it's not really significantly low. You can see we're right at the sweet spot. The VIX is 85% of VIX 3M, the 90-day volatility measure. So that's about as that's the setup here across the board. Is about as bullish but slow, grindingly boring bullish as you could possibly be. So I know we should expect, a lot of times we expect the market should just go up every day, all the time. And the reality is it's not. There are some days the markets just go up a lot, and usually when it's coming up off of pretty big low points. But in a situation like we are right now, the market is just boring, and this time of year lends itself to being boring too. There's not a lot of volatility. The charts are bullish. The volatility is not dropping, but it is low, and that sets us up for slow, small, little moves day after day, short, shallow, near-term pullbacks. And with the seasonality, you'll probably get some more intermediate pullbacks. Some more intermediate runs, shorter intermediate runs, and the intermediate pullbacks will, seem like bear markets, right? Everybody will talk about how now this is it. We're really heading down, but the reality is the long-term trends are intact. The intermediate trends are intact. Every pullback on the intermediate basis is coming down the higher lows. Until something changes in that regard, we just maintain this float. And the other reason, too, it goes so slow is you got rotation, sector rotation, with correlations as low as they are. Different sectors are taking their turns in leadership. Not everything's going up. Some things are going down, and that's also what keeps us to where we're just kind of grinding our way higher. So what do you think? There's a poll popping out in the top right corner. Click on that link. Answer that poll. It's really easy. Do you agree or do you disagree? One or the other. If you disagree with this current market posture, scroll down to the bottom here and comment and let me know what you're seeing that would suggest maybe we should even be more bullish if that's what you disagree on, or if we actually should be more bearish, that you expect that we're going to be dropping here pretty hard pretty soon. So let me know down in the comment section below. All right, now let's talk about what's driving the price action today. And it was a Monday, and it was a summer Monday, and it was a July summer Monday. There's not a whole lot that goes on. You can see that reflected. In fact, over here, you can see there's a lot here that wasn't very much of a move at all. Mid-cap stocks, growth stocks, high-yield bonds, preferred and dividend stocks, municipal bonds. There was a little bit of a bond sell-off. You can see foreign bonds sold off pretty sharply here. U.S. long-term bonds sold off. Mortgage-backed securities sold off pretty sharply. Corporate bonds held up okay, but you can see preferred stocks pull back. MLPs have continued to pull back a little bit, up a little bit today, but you can see coming off high still. whereas stocks kind of holding their ground, specifically U.S. stocks, even with the U.S. dollar holding up. Emerging markets struggled. EFA was kind of flat. International, or the developed international stocks. Here's your real estate stocks as well. If I were to show those over here on the right, you can see they're pulling back too. So this is kind of a U.S. growth, or this is the value, the value area of the S&P 500, and there's your growth. So this is kind of a U.S. stock market, strictly U.S. stock market that is benefiting in a quiet day across the board, and in a day where really the biggest outlying moves occurred overseas, especially in the bond markets and in emerging markets, from the strength in the dollar. And commodities continue, especially agricultural commodities, even though they rallied a little bit, but they're down below a falling moving average pretty sharply. Same thing with gold, and then there's your dollar still holding its strength and not showing a strong, after a big drop Friday, not continuing with that drop quite yet. So we'll see if that reversal pattern plays itself out. And again, crude oil, like these other commodities, also struggling here more recently, but struggling below moving average as well. Again, the only big earnings in the morning before the market open was from Hasbro, which isn't necessarily market moving. Of course, overnight, we've already had Google earnings out, which is pushing stocks up so far in the after hours. Not a whole lot. I mean, we had one economic report out, which is a little bit weaker, and that kind of follows up on a weak housing figure from last week too. Still, we're pretty flat. The economic indicators on a 3-month basis, which is what this measures, weighted towards the indicators that impact the currency volatility the most. You can see they're they're pretty much matching estimates right now on both a U.S. and a global basis. So, how boring can we be right now? We're not really getting any outsized moves, except in the bonds market. Not just here, but everywhere. We're not really getting any outsized moves, and that's the jump in the long-term bonds. You can see, if I were to take a look at even just TNX over here, and then it's up here at the top. In fact, it looks like it's not going to show. So let's bring up TNX right here. TNX up 2.42%. Then you look at like a long-term or short-term yield, IRX, and you can see it was actually down. That yield's down, and so that what that means. That means that the yield curve, even though like on this economic data, it's not going to be updated yet. It's not going to be updated yet for today, but this was as of what would that be? Friday? Yeah, Friday. You can see it was up to 0.29, and based on what we just saw, you can expect that yield curve to continue higher as long as these long-term rates are rising at a faster clip than short-term rates. And it's interesting to see short-term rates not really falling a little bit, because you actually have interest rate hike expectations rising. So here's the December odds, and they're higher. That's 65%. It's not 100, but it's higher than what it was on Friday. So the odds for rate hikes at each Fed meeting where there's a press conference, which is kind of the MO lately for the Fed, continues to rise. So the Fed's still on pace to maintain this rate hike schedule. We've seen in the past that's not a bearish thing, but it definitely produces some headwinds. And if usually rate hikes on the overnight rate, the Fed funds rate, usually will impact the short-term yields more than it will long-term yields, which is what causes the yield curve to flatten out and for the yield spread to drop towards zero. And so the fact that this is rising, but the long-term rates are rising more today is keeping the yield curve pointed to the upside and avoiding that inverted yield curve for a little bit longer. It's an up and down. It's not going to go down every single day. It's an up and down move. But remember, it's once we do get an inverted yield curve, that's when the clock starts to know, okay, when's this this bull market going to end. And on average, it's been over the last so many inverted yield curves, it's been almost 2 years for that clock to start. So we'll see whether that clock ends up starting by the end of the summer or even by the end of the year. I don't even think it'll be by the end of the year. I think it'll most likely be by next year when we start getting press conferences at every FOMC meeting, which opens up the possibility of rate hikes at every FOMC meeting until they're officially done. Which in the past, the last rate hike cycle, they weren't done raising rates until about 4 or 5 months after the yield curve inverted. So just because it gets to negative, the yield spread doesn't necessarily mean that the Fed's going to be done at that point. And they might be done before it gets to an inverted yield curve. But based on past precedent, it looks like we've got some time for the markets to continue to push their way higher without having that headwind of a looming inverted yield curve leading to recession headwind that could be facing and putting pressure on stocks. All right, we'll take a quick look here at the foreign markets, and you can see, Japan had a good, Japan bonds really sold off today. They were one of the biggest movers, but that actually pushed stocks. Stocks rallied on that bond sell-off, and you can see Japan stock is now up to that moving average, kind of breaking above last week's highs and starting to make a run, a lot more than what you're seeing in China and South Korea right now, these fellow Asian economies that are among this top 12 list. You can see the U.S. markets continuing to be one of the. It was here up here at the top pretty much most of last week, and continues to be the case. The U.S. stock market's the only one here. Still the only one that has an intermediate line up above 80. Brazil is close. It's been beaten up for so long. It's now starting to finally turn around and almost get above 80 itself, which will be a very good sign for this really beaten up indicator, or beaten up country, excuse me. But even then, with that, you still had one of the biggest losses today. And you notice too, emerging markets, Korea was Italy, but Korea, Brazil, France also struggling a little bit today, in Canada. Then there's China and Russia. And India, kind of all those three were kind of flat, with your biggest weakness coming in this North American, Brazil. You can see too Mexico having one of the strongest gains today. That's another emerging market area, not inside this top 12 economy, but performing well. Remember, EEM was one of the biggest losers. EFA wasn't so bad, and you can see Japan, Germany, kind of the biggest winners from that perspective. Germany trying to get going here and getting bullish. Same with Japan. Everything else is just below these falling moving averages. Canada's flat, France is flat, Canada's flat, India is flat, and Russia's flat. Italy, UK below falling moving averages. Germany, at a falling moving average. Japan at a falling moving average. So it's it looks like international stocks are trying to form a base after some pretty big sell-offs, trying to form a base, and there may be some opportunity if the dollar were to roll over from that price reversal pattern we've talked about before, for these beaten up international areas, which are all pink, you can see here, to all turn red again or green again, and start making a bullish run, and that might either lift U.S. stocks along with it, maybe not, at the top here, maybe it'll start moving down here at the bottom, but still kind of lift it along with this buying in all these international areas, or might put some pressure on stocks. People might leave the U.S. markets to go into these, which probably more the former than the latter is what we'd expect. All right, now let's take a look at how the sectors are performing, and you can see financials were the biggest winners today with the yields rising. Technology continues to lead the way as well in anticipation of a big week of earnings in that sector. Healthcare, the only other sector that outpaced the markets. Everything else was down. Utilities, staples, industrials and materials are your tariff sectors that are being impacted right now by tariffs. These are your interest rate sensitive, safe haven areas. So this goes to show more of a risk on move. In fact, you can see The only charts that are pink right now are these economic growth sensitive areas: materials, energy, and industrials. Industrial is not as pink. You can see its line is rising, but it still has that falling moving average, so it can't quite get that moving average turning green yet. Staples had been doing so well, it's starting to slow down a little bit, so not really turning. It's seeing its intermediate posture still strongly bullish. Same thing, the utilities has barely turned weakly bearish. So the weakness you're seeing in those safe haven areas are just simply pullbacks right now. But you can see technology is strong above a rising moving average, 90 intermediate line above 90 here. Discretionary pullback to a rising moving average with a strong bullish posture. So there's your strength that continues to be the strength. And financial starting to gain some strength as well and make its way towards the top end of this sector rotation list. All right, now I want to talk about a trade idea of the day, and I pulled up this chart, TLT, which is the long-term bond, 20 to 30-year bond ETF. If you were to look at TNX, which is the 10-year note, the yield for the 10-year note, you can see the jump it's making. It's quite the move higher here, breaking out up 7 basis points today, up to 2.96%. So making another run up above 3%. So a strong move. Intermediate line turning up higher. Of course, the 30-year, you can see the move it's made. And again, these are significant moves. And it wasn't just today. You can see yesterday and really the last week off of that bullish cluster, or oversold cluster, excuse me, that we had here at 2.93%, now up to 3.1%. Significant. Now, get up to 3.25, get above 3.25, and we're moving, right? But for the long-term yields to rally as much as they are is a very positive sign from an economic growth perspective. Right? Short-term yields are impacted by interest rate hike expectations, which are obviously impacted by inflation expectations. Right? Those short-term. Long-term yields like this, very long-term yields, are more impacted by economic growth expectations. And so a 30-year note, like, to have it rise as much as it had in the past two sessions alone, it's gone from 2.96 up 14 basis points essentially, just in the past two sessions alone. And so, of course, short-term sentiment strongly bullish. It's starting to bring the intermediate line up from these oversold clusters to the point where it's about to cross over. So you get TLT and you say, okay, well, we hit this resistance at 122. We're making a run back down now towards support, which is down towards 116. Short-term sentiment's extremely low, which supports this new bearish posture that we've got. So you'd expect that posture to last longer, make its way down. So you can say, okay, well, can we make a bearish trade on bond prices? Well, we can. We can sell the 118. We can buy a call option. We'll buy the 120 call option for an example. Buy the 120 put. Now you notice it's only 25 days out, but if I were to buy that 125 put, I can sell and cover 71 cents of that $1.75 to where now I'm only paying about $1 or less than $1 for a put, for a long put. Now my maximum gain is now capped, but remember, you've got pretty strong support down in 116, so I don't want to buy a put that I think will make a strong move to the downside where there's strong support here. So this trade doesn't need it to get to 116. It can get to 117, 117 and a half, and I'd be fine. It can just meander around that lower end of the channel, and again, we'd be fine. That time decay would just raise the purple line, which is today's P&L, up and up and up until it gets to the green line, which is P&L at expiration. And so, and you can see the maximum gain is $100 compared to what I'm trying to lose here, $97. So a decent 1-to-1 reward to risk ratio here, knowing that we've had this sharp breakdown. And again, if it were to bounce up tomorrow, that's okay, because as of right now, you can see the thetas, it's a slightly negative, but it's only slightly. It's not that big of an issue for us. And you can see here by August the 17th, the volatility currently in TLT alone means that we have a 1 standard deviation, or pretty decent odds of getting all the way down to 116, which is where that support level is. And if stocks continue higher and we sell off bonds with stocks rising, then again, that will help push things down here. Not that we expect stocks to go up too strongly, but you get the idea that we're getting a little bit of a bond sell-off right now, not just here in the U.S. either. It's global, and here's one way that we can take advantage of it with a decent reward to risk ratio. And with the time decay as it is, for us to lose, even half of what we could on this, it would take quite the move to the upside for us to do that. Remember, that resistance is here at 122, so it would take a move, basically nullifying this little breakdown that we've had and getting back up towards this area would be the kind of move it would take. And again, watch this shaded area as time passes. We still got, even if stock kind of meanders around, we still got until around August before the volatility would suggest that 118 is too aggressive of a target. If the stock, let's say the stock does manage to rise up to around 121. So we've got to about August the 1st, really, before 118 at that point would be too aggressive of a move. So we've got about a week or two. In this next week, if it makes a run up into this area, then we say, okay, well, I'll take a $50 loss at that point. Cut my loss in half, and now I have that 2-to-1 reward to risk ratio, knowing when I'll cut it loose and take the loss and when I'll have a decent chance of getting that full maximum gain, which as of right now is pretty decent odds. All right, so that wraps us up tonight. I'd love to hear what your thoughts are. There's a link popping out in the top right corner of your screen. Click that link to go to our Market Scholars forums, particularly to the Market Outlook forum. And there's a post there with tonight's Market Outlook posted. Comment and reply to that topic. And let me know what you think about the market posture, about the charts we were looking at, about tonight's trade idea. Any questions you have for me, any comments. I am going out of town now, starting tomorrow evening. I'll be gone for the next week, so Brandon will be covering the Market Outlook for the rest of the week, and then I'll be back next week. So that being said, thank you very much. Have a great evening, everybody, and remember to subscribe to our YouTube channel, like and comment, also to follow on Twitter and join the Market Outlook community on Facebook. Again, thank you. Have a good one, and we'll see you all next time.